When you're investing in the stock market, it really comes down to two big primary ways of investing, which is fundamental analysis and technical analysis. There's some things you can do with algorithms too, but they kind of tie into the technical analysis. But fundamentals and technical analysis. Fundamentals is kind of what we've already been learning about, understanding the fundamentals of a business and understanding, patterns and things, not patterns, but understanding their ratios and things. And technical analysis is more about if you think seeing things like stock charts or these funny looking candlestick type things and all that stuff. That's what it kind of goes into technical analysis. And we have a whole section on technical analysis that's coming up. But we've really been talking a lot about fundamental analysis, through the course so far. And with both of these, you can use either style, fundamental analysis or technical analysis, or you can be like me to have a little combination of both. I'll use fundamental analysis, for example, and then I might use some technical analysis to kind of maybe reinforce some of my choices. And fundamental analysis also lends itself better to maybe long-term buy and hold investing. Technical might be a little bit more oriented towards short-term trading because you're looking to get in and out maybe quickly on a position. So like a day trader, someone who's constantly trading throughout the day, would be very focused on technical analysis, maybe less so on fundamental analysis. Let's do a quick overview or review of some of the concepts from fundamental analysis, and then we're going to roll right into a whole section on technical analysis around charting, momentum, and all that I think you might find very, very interesting. So if we look at fundamental analysis or fundamental investing, you're looking at the fundamentals, right? Some things that are core to the business. You're really trying to understand the business, and then there's ratios and things that tie into that too from an investing standpoint. So from a fundamental standpoint, you want to understand the business model. You are an owner. When you own stock, you are an owner in that company. So you want to approach it like an owner and understand, what is this company trying to do? What is their business model? How do they differentiate themselves? How do they differentiate themselves from their competitors? How do they appear and approach their customers, and how do their customers see them as being differentiated? What are the features and benefits of their products or services? As a customer, why should I buy your product or service? What's the benefit going to be to me? There's some things in there, some management type things, like is there a first mover advantage? You're the first company to really do something, and you really built up a big lead, or you really took really established a dominant position quickly. Is there a first mover advantage? Is there, compared to other companies, is there barriers to entry or copying from others? Are you really established, and so it's harder for people to copy and replicate what you do? So for example, like Google with its search ability, you have other search engines like Bing and other search engines that are out there, but they don't have the dominant market share that Google does. And so there's a big barrier to entry, not only from a market share standpoint, but a big barrier to entry from a technological standpoint, and building a team to compete with Google. If you and I together decide we want to kind of compete against Google, we may need to find a real small niche to do it, because competing head to head, they have a large barrier to access there to copy them or replicate what they do. And it's a company in for the long term too. What does their long-term prospects look like? When you're looking at companies, especially if you're a long-term investor, a long-term maybe buy and hold investor, that you might hold this stock or hold this company stock for a long period of time, then you might want to look at, well, if I'm going to hold it for 5-10 years, how's the company going to do for 5-10 years? Or is this more of a shorter term trading position? So that's kind of like around some of the keys around fundamental analysis from the business standpoint. And then when we talk about things like ratios, like the price to earnings ratio or dividend yield or different types of ratios, that whole section on ratios, that's also part of fundamental analysis. Ratios are part of fundamentals, understanding the fundamentals of the business. How are they doing right now in this current or past performance, in this moment of time? And can we use that to help predict the future? You have to decide whether that's a predictor of future, or maybe it's a good value to buy in, or maybe how it fits your fundamentals of how you want to be an investor. If you're a dividend investor and you want to have income coming in on a regular basis, well, then you want to look at dividend companies, and so you look at those dividend type ratios, dividend growth rate, dividend yield, those types of things that we talked about. So you're really measuring performance in a current type thing. So ratios are not technical analysis. Technical analysis is looking at charts, it's looking at patterns. We're going to get into that, and that's trying to actually predict what's going to happen in the future based on what's happened in the past, from the movement of, let's say, its stock price, for example, and comparing to moving averages and things we're going to look at here in just a moment. But ratios are more looking at fundamentally how solid is the business, how solid has been the performance, and does it fit with maybe your investing model that you're looking to do. Let's take a quick look at an example of a company so you can kind of see what we mean from a fundamental standpoint, so you can start thinking along these ways. And a little bit more of a review of some of the things we talked about earlier too. So if we looked at Amazon, for example, Amazon, a big global international company, most folks know Amazon. Obviously, you go on their website, you can buy all sorts of products and services. That's where Amazon grew out of and was famous for, particularly selling books early on, but now they sell everything. So Amazon, big brand name. What are some of the fundamental advantages they have? Well, certainly a big brand name. That's why I chose them for this lesson versus something obscure, because I have blessed with students from all over the world, so better chance you're going to know Amazon as far as a big brand name. They have a huge first mover advantage. They weren't the first company to offer products and services on the internet, for sure, but they certainly built their model and built their distribution network and built things that to be very successful. And now the first mover advantage, where they became kind of the kings of internet product sales, is really a big advantage. It'd be hard to compete against them one-on-one. You can find little niches to compete against them, but they're the big guys out there for sure. So they have a huge first mover advantage. They dominate the niches that they're in, dominate that online purchasing. And they have, by doing that, they've built in a lot of technological advantages and distribution advantages too. It's one thing to have the technology, it's another thing to actually take an order and then move that order from a distribution center to another part of the country or another part of the world, possibly, to get that product to the customer in a timely manner, in a manner where the product is damaged and quick and fast, and have all that branding around it. So they got those types of advantages. So if you think about fundamentals, wow, that's really good. And then you can look at, let's look at some of the ratios and financials, at least at a moment in time around this. But if you look at fundamentally from a business model standpoint, you might say, okay, they're pretty good. They're certainly a big player for sure, as far as some advantages. Now, if we look at some of the ratios and some of their financials, they got a lot of cash on hand. They get tons and tons of cash, which means they can do things with that cash. They can buy things with the cash, other companies, invest in new products. We'll talk about that in a moment, but they've got a lot of cash on hand, which is really good versus maybe a company that's cash strapped. Now, their price relative to their earnings, right? Their price of their stock relative to their earnings is like 286. It fluctuates, but it's around 286 right now, and it goes up and it goes down, all that. I mean, it's just like massive. It's like almost, how do you even equate that? I mean, if something that high, you'd say it's way overpriced, you'd never buy it, but it's a growth stock, and the idea is this could keep growing and building, and people are willing to pay a high multiple to earnings. You heard about earnings multipliers. They're willing to pay a high price compared to the current earnings because they're buying into that future growth aspect, that dominant growth. Amazon doesn't pay a dividend at this time, so there's no dividend measures, because they're a classic growth stock. They don't want to pay us, you and me, the investors, as a dividend. They want to take that money and invest it in new things into the company to help grow the company and get our return on our investment through capital appreciation, as in the stock price keeps going up and up and up is the idea. So they're a classic growth company. You can look at this from a fundamental standpoint. This is how you'd want to think about companies. You could say, maybe you'd look and say, I understand the business model, I think they're doing great, maybe I want to invest in them from that standpoint. But then another investor might say, yeah, but and it's nice they got a lot of cash, but I'm really worried about the price I'm paying from a stock price. Maybe there's better choices, better value out there for me. And maybe I want to invest in something that gives me a dividend too, so I might pass on Amazon. So that's why investors look at all these investments different ways. Remember, to have a stock trade, you got to have somebody who wants to sell and somebody who wants to buy. And people are buying and selling, they have different perspectives on how the future prospects of the company would be. So could we predict the future of Amazon? No, we can't predict the future of them, but we can have a feeling about that, and the questions we want to ask in ourselves as investors in this example. And really the key example for this with a growth company is, can they keep growing? Can they keep growing at the rate they are growing? And then you can look deeper into the numbers and say, what are they going to do with all that cash? Might they pay a dividend in the future, which might help their stock price too? Will they pay a dividend in the future? Will they buy back stock, which also helps raise existing owners of stock, raises the prices up? So stock buybacks are good. Maybe they'll buy some stock. Maybe they'll acquire companies. Acquire companies, like there was an acquisition of Whole Foods, more United States based, but Whole Foods was an organic store selling food, grocery store selling food. An interesting play by Amazon to buy Whole Foods. But they got that cash, they can use that, to help buy on other ways, to finance, of course, buy companies like Whole Foods and expand their reach. Or expanding their reach through new product offerings. Research and development would be typical in companies. What are some new products or new offerings they could do? So we'd think about that. Can they use that cash? Can they use those investments to keep investing in the company? Through things like new product offerings and extensions. Here's just a list of a few things that Amazon has done, from going from basically somebody sold books essentially to more goods and services to things like Amazon Prime, Kindle e-readers and all that. Streaming services now, growth area streaming services of video and music, getting involved with video and music, and certainly they sell devices now with Echo and Alexa. Here's a picture of Echo, devices that they sell themselves in addition to all the other products they sell. And then you have Amazon Web Services, where they provide services, web support and web services to other companies. So they really kind of branched out that way too by using their expertise in that technology and web design and web services and transactional services, and using that to make another revenue stream for them as well. So there's an example where fundamentally you're looking at this company from a fundamental standpoint. In the next lessons, we're going to start talking about a technical analysis where you're really not even looking at the fundamentals, you're looking technically to see how is the stock price moving and how does that compare to where it's been. And the idea is you're trying to look at an opportunity to buy in and then sell. So next lessons are going to be about technical analysis, and it's going to be different than some of the fundamental analysis that we've been doing. Oh, and last point here too, by the way, you can use, as I said before, fundamental or technical analysis, or you could concentrate 100% and just be a fundamental investor and you'll do perfectly fine, or you could be a 100% technical investor and you could do fine as well too. You don't have, one is not necessarily better than another, it's more about what fits you and what you like to do and how you want to approach it. But they're both two schools of thought that have both been successful over time.